subscribe and press the bell icon.
Of the billions of dollars in customer deposits that disappeared from FTX in a flash, $200 million was used to fund investments in two companies, according to the Securities and Exchange Commission, which charged founder Sam Bankman-Fried with orchestrating a scheme to defraud equity investors. Through its FTX Ventures unit, the crypto firm in March invested $100 million in Dave, a fintech company that had gone public 2 months earlier through a special purpose acquisition company. At the time, the companies said they would work together to expand the digital asset ecosystem. The other deal the SEC appears to have referenced was a $100 million investment round in September from Myston Labs, a Web3 company. In total, it was a $300 million funding round that valued Myston at $2 billion and included participation from Coinbase Ventures, Binance Labs, and Andreessen Horowitz's crypto fund. While FTX Ventures has done dozens of transactions, according to PitchBook, the Myston Labs and Dave investments were the only to disclose investments of $100 million, based on documents published by the Financial Times, which broke down how the company put $5.2 billion to work. FTX Ventures was described as a $2 billion venture fund in its press release, with Dave Bankman-Fried, 30, stands accused of committing widespread fraud after FTX, which was valued by private investors at $32 billion earlier this year, sank into bankruptcy in November. A central theme in the charges is how Bankman-Fried diverted funds from FTX to his hedge fund, Alameda Research, which then used that money for risky trades and loans. FTX Ventures was allegedly part of that scheme. Dave CEO Jason Wilk told CNBC that FTX's investment in Dave is already scheduled to be repaid, with interest, by 2026. FTX's $100 million investment was through a convertible note, a short-term loan of cash that FTX could convert into shares at a later date. That conversion was never made, leaving Dave with a $101.6 million liability, including interest, to FTX and any successor companies, according to the company's most recent SEC filings. FTX's investment in Myston came in the midst of a crypto meltdown. Bitcoin and Ether were down by more than half for the year, and numerous hedge funds and lenders had gone bankrupt. The funds were to be used in Myston's effort to build a blockchain that scales with demand and incentivizes growth, Myston CEO Evan Cheng said at the time. Representatives for Ellison and Wang did not respond to requests for comment. A representative for Bankman-Fried declined to comment. Ellison, 28, and Wang, 29, pleaded guilty in New York last week to federal charges over the illicit use of customer funds for trading and venture investments, allegedly directed by Bankman-Fried. Both are cooperating with federal investigations into Bankman-Fried and the collapse of FTX.
Thanks for watching.